My guess with 4 tranches right now, we're probably going to be reasonably small, somewhere in the sort of $5 to $10 billion range.
Total.
Total right now.
Why even bother with $5 to $10 billion?
Exactly.
Yeah, it's a rounding error.
Well, why bother? I don't get it.
Well, listen, they have $30 billion of debt coming due in the next 3 or 4 years. So I think you're going to see more of this. The question might simply be, what do the rate hedges look like? What's their forward view of what they think borrowing costs are going to be? Ultimately, though, listen, this is a serial borrower, and they are a serial shareholder reward giver. So you're just going to see more and more of this. We already saw this last week with Alphabet, and I think you're going to see others follow.
I mean, the basic idea is they issue this new paper because they're retiring older paper, right?
Well, I've spoken about this in the past. It sort of goes back to my early days at math camp. Their weighted average cost of capital is dominated by their cost of equity, which is about 9.25%. And their weighted average cost of debt is effectively zero. When you have a $3 trillion equity market cap, the cost of debt is nothing. And that's why they keep $100-odd billion of debt on the books. So it makes math sense to borrow money and buy back more shares or give it away in dividends. And that's what they do. The real issue with Apple is they have a problem, and their problem is they make too much money. They have $100 billion of annual free cash flow. So it keeps flowing in. And so what do they eventually do with it? Well, they give it away. But, you borrow a little bit at a time. And for Apple, that's $5 or $10 billion chunks.
Some people might say that's a good problem to have. Essentially, what you're saying is don't look too much into this in terms of the timing, in terms of what you think they're going to do with the cash. Because I asked Tom earlier, do you think this has anything to do with tariffs, the timing of this? This is a company that makes so much of its products outside of the U.S., so many of its products outside of the U.S. We heard from Tim Cook and co. last week about India and about production of the iPhone that's at least coming to the U.S.
Okay, but
anything to do with tariffs?
Come on, Tim Cook was in Omaha. Did Buffett is last rites just to cook grow? I'm serious.
Yeah.
Grow up and put your capital structure adult. Is that what happened?
Yeah, not at all. So listen, I'm a credit guy, so I don't want to completely poo-poo tariffs, but Apple just reported and they said they're going to have $900 million in incremental related tariff charges. This is a company that generates $500 billion annually in revenues. It's a spit in the bucket, and I understand from an equity perspective how $1 billion makes a difference in earnings and how it projects out to long-term discounted cash flows and getting to an equity price. But from a tariff perspective, I mean, the numbers are insignificant. I mean, think about it. Let's say the number was $5 billion or $7 billion. Okay, so they generate $98 billion in free cash flow versus 105.
What's a normal debt perspective of an industrial or a consumer discretionary company? Like 15% debt?
It's widely different, and in tech, it's dramatically lower than most other sectors.
Why?
Because the market caps are so much higher. When you're talking about $2 trillion or $3 trillion market
boards
caps,
say we need to issue more debt, even if it's not out.
well,
to
listen, there's
10 or
absolutely
15?
when you have your PM friends on, you ask them this question. The problem is you're only allowed to allocate so much of your portfolio in both relative and absolute dollars to certain names. So a name like Apple that has $100+ billion of debt or in and around that range, there's only so much exposure for these large buy-side firms that they're allowed to have.